Good evening to all. Welcome to the live webcast on that one is venture capital fundraising. And we have with us today's resource person, CA Tarun Chaurasia, who has a lot of experience in that one is particularly venture capital funding. And he has been working in that one is venture capital funding for the years. And he has been experienced person in that startup ecosystem. And he has been worked for the years in the particularly the venture capital portfolio. With this, we welcome to CA Tarun Chaurasia into this session. We have with us our Vice Chairman, Committee on MSME and Startup, CA Dr. Raj Chawla. And that one is he's particularly in our committee in that one is as a vibrant and that one is committed. And right now he is working in the relentlessly for the development of the chartered accountant in the MSME and startup ecosystem. CA Dr. Raj Chawla earlier worked as a vice chairman and vice chairman of that one is NIRC of ICAI. And he has been relentlessly working for the members of ICAI in various forums, in ICAI forums as well as in the social forums. With this, we welcome to CA Dr. Raj Chawla, and we are also requesting him for his address.
Thank you, Dr. Sambit Mishra ji. Dear professional colleagues, at the outset, I am happy to be a part of this live webcast on Roadmap to Venture Capital Funding organized by the Committee on MSME and Startup of ICAI. We are thankful to all the participants and resource person, CA Tarun Chaurasia, for joining in this live webcast. Investment funds that help investors seeking private equities in startup, small and mid-sized enterprises possessing strong growth potential by managing their money are known as venture capital funds. They are institutions that are dedicated to finding new ventures and are regulated by the guidelines issued by the Security and Exchange Board of India. Though there is a high risk involved in funding new projects, the investors are eager to do so because they anticipate high return on the investment. Venture capital funds assume that the money of the investors is used to fund projects which have a potential to grow, and the money provided in the process is known as venture capital. Venture capital funds are given out on the basis of the company's assets, size, and stage of product development. Since these firms in question are usually startup, small in size, they are said to have high risk, high return profiles. I am happy to inform you that today's session will highlight on the venture capital funding. We hope that the enhancement of the knowledge in the MSME and the startup sphere helps you in your future endeavor. Thanks and best of luck for your future professional and personal endeavor. Thank you, Sambiji.
We once again welcome to CA Tarun Chaurasia to this session. And as an experienced person in that one is particularly the startup ecosystem, you will deliberate in that one is particularly the expectation of our members. And with this, I am handing over the session to CA Tarun Chaurasia for further proceeding.
Thank you. Thank you very much, Dr. Sambit, and thank you very much, CA Raj Chawla. It's a pleasure to interact with you and pleasure to interact with all the colleagues, professional colleagues from the Institute. I have had the opportunity to work for a well-known institutional private equity fund for close to about 10 years, from 2009 to till 2017. Starting from the time when the idea of setting up a fund was conceived, up to the point in time when the fund was actually set up, and then it did make a number of investments, and then finally we returned capital back to the investors. So what I will do, I will try to share my whatever I have learned till date in the venture capital and private equity industry, over the last 14, 15 years to my colleagues and to my fellow members. So what I will do, without taking too much of time, I'll just share my screen and then we'll talk about more. All right. A bit of catchy line: fundraising is an extreme sport, and be cautious about it. I've written it deliberately, and I strongly feel that fundraising it's really challenging. It takes a lot of time, a lot of efforts for any business owner and for any startup owners to raise funds. So you really got to be very cautious about it. Sorry, I'm just not able to move my screen. All right. All right. Before we, what I will do, I'm dividing this entire presentation in two parts. Section one, we're going to talk about how a typical private equity fund or a venture capital fund operate and work, so that you have a very basic understanding and knowledge about the ecosystem of a typical VC fund operation and its working style. And then we pause it and take up some of the questions so that we can make it more interactive. And in part two, we'll talk about how typically a startup can raise venture capital from and a step-by-step guide to it. And then we'll take up the questions again. So in India, we have raised about $38.5 billion of investment in the year 2021, which is about 3.8x growth over its previous year, which is 2020. And the growth that we have seen in China in the year 2021 is only 1.8x. So we have surpassed China as far as the funding is concerned in India. Second, we have seen 44 unicorns in the year 2021 against 42 unicorns in China. This is the highest number that we have seen in 2021. We have seen that the number of deals in the venture capital and private equity industry, it has grown up 2x. In 2020, we had 809 deals which was invested. And this year in 2021, we had 1,545 deals. We have seen an increasing active investor base from 516 to 660. An ecosystem of 50,000 plus active startups, and the global share has grown up from 3% to 5.6%. So 2021 has been an exceptional year, and these numbers are extremely, it reflect the shining ecosystem of private equity and venture capital industry. Let's see how funds really work, and I'll give you a practical example of it, right? Typically, a P fund or a VC fund composed of two sets of people. So you have a general partner, we call it as GP, and then you have unlimited partners here. Hello, can you hear me?
Sir, you have disconnected.
Hi, can you hear me?
Right now you are visible, and that one is you are not visible. Your audio is right now is there.
One second.
Parth, होस्ट बना दो. See Tarun.
Yes, sir. Sir, got it. I'm back. Sorry, can you look at my screen? All right, perfect. All right, when you set up a fund, typically you get to see two sets of people. One is general partner and second is limited partners. These two people basically form a fund. Let me give you an example. Let's say today I decided to set up a VC fund. Okay, and what I will do first. The first thing that I'm going to do, I'm going to decide what is the size of the fund that I'm going to raise. Let's say I decide to take a $100 million fund. Second thing, what I will do, I will decide on the investment strategy, right? What would be my investment strategy? Will I invest in India market? Will I invest in outside India? What would be my ticket size? What kind of a sector that I'm going to invest, and blah, blah, blah. So I will draw up my investment strategy. Third, what I will do, I will structure my legal entities. I will take necessary approvals from SEBI and other authorities, and that's how I will structure the entire fund. Once I build up my entire fund thesis, my investment thesis, my entities, my structure, everything in place. Second most important thing that I'm going to do is actually to market my fund. I will go out in the market and I will pitch myself before limited partners for prospective funding commitment to my fund. So the journey of fund, raising a fund, is pretty much similar to the journey of any other startup raising fund for their venture capital, for their businesses. Just like a startup owner pitch to a fund for a prospective funding commitment, very similar to that, the general partner, he makes a pitch to a limited partner for a prospective commitment as far as the funding is concerned. So this is how the general partner and limited partner join hands and create a pool of money, which we call is a venture capital fund or a private equity fund. The fund can be set up onshore or the fund can also be set up offshore. Typically, you would have seen that you have got funds set up in Mauritius, Singapore, and any other tax haven countries. So it could be rooted either as an FDI, or if it is an onshore fund, it could be one of the fund registered with the SEBI, like alternate investment fund category 1, category 2, or category 3. So that's how typically you set up the fund. Now, general partner, who is also one of the investor in the fund, is also the investment manager of the fund. Now, who is the investment manager? The investment manager of the fund is actually somebody who is responsible for managing the entire day-to-day operation of the fund. So he is the one who has been given the task to identify an investment opportunity, to actually evaluate an investment opportunity, to prepare an investment committee note, submit an investment committee note, get the proposal clear, and ultimately make the funds available. So you are the real working guy on the ground. You could be acting as an individual, and you can also be acting as an institutional partner here. What is it that investment manager or a general partner gets in return for raising and setting up a fund? So two things. One, you get a management fee, which is usually 2% of the capital committed by the investors in the fund. And second, you get a carried interest, which is somewhat similar to kind of an incentive and a bonus, which typically you make money when you liquidate your investments. So this is how typically the structure of the fund is. We've talked about three sets of team. One is the investment team, second is the investment committee, and third is the deal team. So investment team is a set of people who are specialized, having the necessary experience and expertise as far as the investment work is concerned. So they are the employees which is hired by the general partner. So when you interact, when you submit your pitch to a prospective VC investor, you actually submit to one of the investment team members there. Investment committee. Investment committee is basically a group of people primarily consist of senior investment professionals and usually represented by limited partners and general partners. So a representative of various investors form part of an investment committee. The prime role of investment committee is actually to approve or disapprove a particular investment when submitted by a general partner. Third, deal team. So every time you send a proposal to an investors, right, there is this one person who has received a proposal, and within the fund structure, there is a deal team. And deal team is typically consists of a fund manager and an analyst. So usually it's 2-member team who has been given the task to evaluate a particular investment process and then takes a decision whether they want to go ahead with the investment or not. So these are some of the terminologies which I wanted to all of you to get acquainted with. So you've got general partners, limited partners, investment team, investment committee, deal team. These are some of the categories and kind of funds that you would come across, as limited partners. They could be individuals as HNIs, they could be corporates, family offices, mutual fund, insurance companies, fund of fund. A fund of fund is another category of fund whose business is primarily to make investment only in the fund, right? So there is a startup, and above this startup there is a fund, okay? And above the fund there is a fund of fund. The business of the fund of fund is to identify various VC funds and private equity funds where they can act as an LP and make some investments. So we call it fund of fund. Then you have pension funds. Then you have sovereign wealth funds like Abu Dhabi Investment Authority. You would have heard this name multiple times. You have Canada Pension Fund Investment Board, Singapore Government Investment Corporation, and many other names like this who have been actively investing in India. And then you have development financial institutions. So you would have heard these names quite frequently, like IFC, CDC, FOMO, DG, Proparco, and there are many more. And then obviously there are banks and other financial institutions. All right, fund close. It's interesting. So first close basically means that when a certain threshold, when a certain threshold of money has been raised, the PE firm can begin investing and actually closing deals, and a new LPs can still commit capital for a limited time. So let's take an example that I went to the market with a aim that I would raise $100 million for my fund, and within the constitutional documents of my fund, I aim that if I raise $70 million out of the $100 million, I will call it as a first close. Now, what is the meaning of first close? It basically means the moment you got a commitment of $70 million from the prospective investors, which are LPs, I will start working. I will open up my shop, let me put it this way, which effectively means the work of identifying an investment opportunity, the work of evaluating an investment opportunity, the work of actually making investment in those companies will actually start. On the contrary, or concurrently, I will continue to work on raising rest of the $30 million, right? So we divide it. Usually the funds divided in two parts. I've done my first close, means okay, $70 million done, and let's start working. And the balance $30 million will keep on raising over a period of time. And then after maybe a 6 months or maybe 12 months time frame, the fund will say, okay, we have done another $30 million, or maybe you failed to raise that kind of a money, which is 100, which you initially targeted. Maybe after 70, you raise, let's say, another 10. So you will call out, okay, the final close of the fund is done, and the size of the fund is not 100, it's actually 80 or maybe $90 million. So it's basically two different milestones within the fund raising cycle. All right, this is the most important slide in this presentation, and I want everyone to please spend time onto it. This is also the common mistake by majority of the advisors, and also over 90% of the business owners and startup founders. When a fund is being constituted, it comes out with a well-defined investment strategy, right? So every fund is unique, different in terms of its investment thesis. Now, what is investment thesis? The investment thesis is ticket size. The investment thesis is what kind of a sector that you're going to make your investments. What is your theme of investment? Third, what is the geography where you're going to make the investment? Fourth, what kind of a business that you're going to make investment? And last, which is the negative list. Let's take one by one. Ticket size. Now, every fund comes with a strategy that this is my ticket size. This is the size of the investment that I'm looking at. So I will not invest, let's say, below $1 million, but I will not invest beyond $10 million. So my ticket size is $1 million to $10 million, right? So if you reach out to an investor, let's say you're looking for a $50 million for your company. If you reach out to that particular investor, let's say for a $20 million check or a $50 million check, he will say, sorry, I can't do that. My charter document doesn't allow that. My investment strategy is that I can invest in one company only between 1 million to 10 million, right? So it's very, very important that when you reached out to an investor, you need to have a very clear understanding that what's the ticket size for this particular fund. Second, sector. Now, not every VC fund or every private equity fund can be approached by you. You need to really look at what kind of a sectors that these funds or this particular fund is targeting. Is it targeting to make investment into education? If it belongs to an education, if you're an education company, if you're into real estate, does this fund makes investment into the real estate? And there are many more sectors we can keep talking about it. Now, besides a sector, there is another thing that you will notice is a theme. For example, there are two different funds. Now, both of them makes an investment into the education space. But one particular fund says, while I make an investment into the education space, but I want to ensure that it should be an impact-driven investment education. If it is not making an impact, down at the bottom, then this is not a sector or this is not a company where I would like to make an investment, right? So take for an example, if there is a company who's making a deep impact to the village life, to the lives of the people at the bottom of the pyramid in the education company, then it becomes their investment thesis versus maybe a very, very typical, let's say any edtech startup, right? So there are different themes which these funds are typically targeting. Third, location, right? Here we are primarily and largely talking about India-centric businesses, but there are funds which is globally, targeting investments globally. So please make sure that when you approach an investor, you need to ensure that this particular investor makes investments in India. There is no point in reaching out to an investor who doesn't make an investment in India. Fourth, the businesses. Now, while you have a clarity on the sector, you have a clarity on the theme, you have a clarity on the ticket size, you have a clarity that this particular fund makes an investment in India, business, at times the funds classified and they clearly state that, okay, there are certain businesses that they may not like to invest. There are certain category of businesses they like to invest. And I give you a practical example. When COVID hit the country in 2020, most of the funds they were revisiting their investment strategy because of the COVID things happened, right? So I have returned responses from several investors where they have clearly specified that, look, while my charter, my constitutional documents clearly states that this particular sector is very much within our radar, but for the time being, we are re-looking at our investment strategy, and these are kind of the businesses which may not like to invest at this point in time. So they usually have likings, and it keeps changing. It's very from every year you might see the liking or the preference of these fund managers changes. Last is a negative list, which basically talks about a list of investors or a list of businesses where the fund is very clear that they wouldn't make an investment in such kind of sectors and in such kind of businesses. So my friends and my colleague, please note that without looking and understanding the investment thesis of a fund, do not approach any investor. It would be complete waste of time. You will get into disappointment because you may not get a response from them. All right. Investment period. Investment period vary depending on the PE firm's philosophy and approach. It has historically averaged 4 years. So once you close the fund, the first close. So I'll go back to the previous example that I tried to raise $100 million. I did my first close of the fund at $70 million. In the charter document, this investment period is defined. As I mentioned here, usually it is in between 4 to 5 years, which means that whatever the fund that you have raised, you got to invest this money within the investment period, right? So you get onto the job, you raise the money, and it's time to identify the opportunities and makes an investment in the next 4 to 5 years. It's not open-ended that you've got the commitment and you will keep investing that money for the next 10 years or 15 years, right? So you got to invest it in that time frame. And after that time frame, you got to manage it. You got to add value. You need to sell those portfolio companies where you have done the investment. So usually the life cycle of a fund tends to be in between 8 to 10 years. So the first 4 years you make an investment, and the balance, 4 to 6 years, you basically recoup the money which you have invested, which effectively means you are into the business, you are making a value add to a portfolio company. As fast you're approaching to the liquidation cycle of your own fund, you wanted to liquidate all those investments so that you can return capital back to the investor and makes it tons and tons of money out of it. So that's how typically funds operate. All right. Very commonly, and we hear these terms, venture capital and private equity. Technically, it's not defined anywhere, and there is no line of demarcation. Okay, this called venture capital or this called private equity. Like when I say this, I mean that I cannot say that if you have this much of revenue, it can be termed as venture capital. And if it goes beyond this number, it can be termed as private equity. This terminology is used basically to differentiate the businesses. So if you're an early stage business, we call it as a venture capital funding. If it is a later stage of business, a later stage of funding, we call it as a private equity, right? So again, this is part of the investment thesis. When you set up the fund, okay, this is part of investment thesis. Would you invest in early stage businesses, or will you invest in more mature and established businesses? So that's how we typically define this is a venture capital fund and this is a private equity fund. As far as the working mechanism of both of these funds are concerned, it really doesn't make too much of a difference, except the fact that private equity is generally goes for a bigger ticket. It goes for more mature and more established companies versus a venture capital, which primarily and largely make investment in a lot of early stage companies. All right, we have been again reading and hearing these terms quite often. Someone gets his or her idea funded, somebody gets a seed funding, somebody gets a bridge round, and then you have a pre-series A round, and then series A, B, C, and D. These are nothing but defining a different stages of a particular business. To start with, idea or a concept stage, which we also call is a pre-seed funding. Uh, what it really means is that you have just an idea on a piece of paper, or you might be having a well prepared presentation, and then you're heading out to an investors, pitching your idea and trying to look out few $100 to kick off your business. Frankly speaking, with a lot of practical experience and insight into this industry, I can tell you, uh, 1 out of 1,000 that somebody will fund your idea at a concept stage, right? Majority, when I say majority, I would say 99% of the VC funds currently operating in this market, they do not fund an idea until you are somebody into the industry. Like you may be a founder of some large businesses, and you come out with an idea and you approach some particular fancy VC fund for a check. Maybe because of your backing and standing in the industry, you get that check, but practically you don't get it. Or maybe you have an exceptionally differentiated innovation that you're coming on board. But the practical side of it, that ideas are not getting funded. What is getting funded? It's the execution. It's your capability and how far you have been able to scale. I have seen businesses which is difficult to digest. That can this be funded? Recently, you would have heard that a samosa wala, got funding. I mean, it was amazed to see a samosa wala is securing a check. So, and there are many more examples like this. And what I've seen and witnessed, that it's not the idea. As long as whatever the hell idea that you have, if you're able to scale up and you show it to the investor, look, I started this business and I moved here, right? Trust me, you can secure a check. It could be a small check, but you will be able to get funding. So scale and your execution is the key here. Second, seed or product stage is basically, this is a stage wherein your product is ready, and you may not have marketed, or maybe you have started marketing it, or maybe you have started generating a bit of revenue. So there are several VC funds available in the market who can give you a seed stage funding. Again, I repeat that it's important that you should have some bit of a scale. I've seen startups coming up to me with 10 lakh of revenue, 20 lakhs of revenue, and trust me, it just doesn't work. I mean, keeping certain exceptions here and there, it just doesn't work. Everybody is keen to look at कि भैया धंधा स्टार्ट किया है, करा कितना है, कितना कर लिया ये बताओ. That's the $1 million question which every investor is asking for. Nobody is interested in your product, idea, blah, blah, blah. Bridge funding is basically a bridge between a seed fund and a pre-series A round. You basically you're not ready for a bigger round, and you're temporarily looking for a small amount of funding so that you can reach quickly to a certain point in time before you're being ready for a bigger check, which is pre-series A round. And then there is series A, series B, series C, series D, and so on and so forth. Now, these alphabets is nothing but represent a follow-on funding after one another and so on and so forth. So usually the idea stage, the seed stage, the bridge funding, the pre-series A, we generally these fall in the bracket of early stage funding, while the series A, B, C, D, they typically fall in a late stage funding, and we can also call it a growth capital or a private equity rather than a venture capital. All right, committed capital versus a capital call. So when you raise a fund, you approach a limited partner. Okay, so given the example of $100 million, I raised $100 million, $90 million of fund. I approached multiple LPs. Each of the LPs committed certain amount of money. Somebody committed $10 million, another one committed $25 million, another one $15 million. That's how the pool of money comes into the picture of $90 million. Are these funds are actually disbursed by the LP to the fund? The answer is no. We call it as a committed capital. It's a commitment by respective LPs to the fund, right? And then there is second term that we use, capital call, right? Now, what is capital call? So every time a general partner identify an opportunity, or let's say identify an investment opportunity, he evaluate it, he submit it to the investment committee for approval. The investment committee approves it, and post approval, it's time to fund a particular portfolio company. The time when it comes that you got to fund a particular investment, that is the point in time that you make a capital call to your LPs, right? So let's say you decide to make a $5 million investment, okay? So this is the time when you send a return notice to your LPs, it's a capital call that, look, we have investment committee has approved $5 million in ABCD Private Limited. Please pay up your respective shares. And that's how, basis that capital call notice, these LPs pay or disburse funds from their respective bank accounts to the bank account of the fund, and then fund will further make an investment. I've personally sent several such notices in the past. So we call it capital call notice. All right, this is very interesting. Venture capital co-investing is on the rise. I guess, the dynamics of the venture capital industry has completely changed over the last 4 to 5 years. Prior to 2015 and 2016, most of the investments that you get to see in the market, they were primarily a single investor investment, right? You do not see more than one investors. Or at best, what used to happen that these funds, they used to loop in their LPs to co-invest along with them, right? Take for an example that your mandate or your ticket size to make an investment is maximum $5 million per company. But you have received a deal or you have received an investment opportunity to make an investment. It's not 5 million, it's $10 million. So what used to happen and what also happening now, that you offer to your own investor who are your LPs into the fund, that would you like to join us separately over and above your share in the fund? So you make an offer to your LPs that this is a $10 million deal. Why we're going to invest 5 million from the fund, and any one of you like to pick it up, right? So some LP say, okay, I can put in $5 million extra from my check as an individual investor. So that's how co-investing used to be done. But in the last 3 to 4 years, the overall dynamics of the venture capital funds has changed. Almost every single deal that you get to see in the market, every single deal, you have more than one investor who is joining in the deal. So it's like whether it's a $500,000 deal or it's a $5 million deal or it's a $50 million deal, you will see that you have at least 2 to 3 investors joining that particular round. So it's not a single investor investments anymore. In terms of the numbers, I can confidently say that over 90%, over 95% of the deals that you get to see, they are co-invested by multiple investors. It's not just the LPs anymore, right? So there are multiple funds operating in different the different investment theses. The pooling that comes together, and that's how they fund companies. So co-investing is on the rise. That's the message here. Types of investors. So you would have heard incubators or accelerators. You would have seen angel networks, venture capital and private equity investors, family offices, and strategic investors. I guess majority of the different category of funds or institutions who are making investments fall in one of these categories. Incubators or accelerators are small organizations or small institutions who are being mandated and given the task to help a startup owner, to motivate a startup, to give them a small funding, to provide them a co-working space, and so on and so forth. So they basically guide the founder in their business journey. Sorry, I'll just have a look at the time so that we don't miss it. Angel network, very commonly used. There are several angel networks which is currently operating in the market. What is an angel network? Angel network is nothing but a network of HNIs, right? So all of these HNIs who earlier used to make direct investment into a startup, they have all joined, if not all, majority of them have joined one or the other angel network, right? So we as a startup company, we submit our pitch deck, our proposal to an angel network, and behind the angel network, there could be 100, 200, 500 individuals who is backing that particular angel network, right? So angel network here act the job of a GP, general partner, or the job of an investment manager who screen your proposal, who evaluate your proposals, who submit a note, and then submit to their HNI network. And then HNIs, try. It's like a voting. Okay, I'm in. I want to make investment. I will give my 10 lakh. Somebody say I'll give my 50 lakh. Somebody say I'll put in 5 lakh rupees, and that's how a pool of money gets invested into a startup. Third, venture capital and private equity funds. These are largely and primarily institutional funds with their unique investment thesis and run more like a very, very typical hardcore VC and PC private equity funds. Next, we have family offices. These are some of the large industrial houses who set up their own family offices. Basically, the money which they wanted to invest into this particular sector. So they've set up a small pool of fund, and they're looking to make investments into various category of businesses falling in the startup domain. And then strategic investor, we all know and understand, who is a strategic investor. So let me make it clear. Venture capital and private equity industry, they are all financial investors. There is a big difference between a financial investor and a strategic investor. Financial investor, we define is somebody whose business is to make investment, somebody who is investing into another business to make a lot of money so that it can return money back to their own investor. They have a different agenda, they have a different mindset, they have a different objective, and they operate in a completely different manner versus a strategic investor who has a strategic point of view to your investment, and it can make a hell lot of difference in adding value to your business. So given a choice, I would always advise to any and every startup owners, why don't you find and get a strategic investor on board for your portfolio company? So these are some of the different category of investors that you get to see in the market. I've just drawn up this list of incubators and accelerators. I'm sure you would have heard these names: Venture Catalyst, 9 Unicorns Accelerator Fund, Microsoft Accelerator Bangalore, Accelerator Ventures, India Accelerator, IIM Calcutta, T Labs, CIIE, The Morpheus, VHub, GSHub, 10,000 Startup. All of these are different incubators and accelerators spread across the country with a different objective, with a different set of theses, with a different sort of understanding, and the early stage startup founders can actually connect with one of these incubators or accelerators. These are some of the names that you would have heard of angel networks, Mumbai Angel Network, Indian Angel Network, Chennai Angel Network, Jito Angel Network, Lead, different angel networks operated and run by different set of institutions or people, but the unique and common commonalities among these angel networks is they're all backed by HNIs. The magnitude or the number of HNIs backing each of these angel networks could be different. So I guess two of the famous angel networks, and we keep hearing from them, is Mumbai Angels and Indian Angel Network. These are some of the family offices: Malpani Ventures, FA, Sharaf and Company, Credence family offices, Raintree family offices. This Raintree belongs to Zerodha Guy, and there are many more. Investment decision in family offices are relatively easier than a typical VC or a PE fund, because it's their own funds. They don't have to run through a standard process, which usually a VC or a PE fund has to operate. All right, type of investors. So now there are different categories of fund. We talked about venture capital fund, who makes an investment into early stage of businesses. Second, we talk about private equity funds, who makes an investment into businesses which are more mature, established, and come at a later stage. There are third category of fund, which is buyout funds. So these are again venture capital. These are private equity funds whose investment thesis is actually to buy you out, or if not buy you out 100%, maybe to secure a controlling stake into your business, which is above 50% into your business, right? So it's not a good idea to approach any of these buyout funds when it comes to raising capital for your startup. You need to be very, very clear in terms of who are you talking to. And there are fourth category, which is a distressed and a special situation fund. Again, their investment thesis, their charter documents, they very clearly specify, everything remains same, but you will make investments only in companies which are distressed and are special situations. And then there are fifth category, venture debt fund. Now, what is a venture debt fund? It typically works pretty much similar to a VC fund or a PE fund, but as its name denotes, it's a debt fund. So they make investment either alongside another VC fund or after that, right? So their predominant investment thesis is, if you have an equity investor ready to put in money into your business, I will also put in some money in the form of a debt. Relatively, with flexible terms and conditions versus any other bank, financial institution, or an NBFC, right? Or if you're already funded by any other venture capital or a private equity investor, I'm happy to come in and provide you debt funding, right? But for them, it is important there has to be an investor investing alongside or has already sitting there into your business. So there are multiple venture debt funds which is currently running in the market who are ready to give you a debt funding, somewhat different set of terms and conditions, which is different from a typical bank or an NBFC. All right, we have done with part one, and we discussed and talked about how a usual venture capital or a private equity fund operate. Section two, we're going to talk step-by-step process and guide how to secure a venture capital funding. But I would like to take a quick 5 to 10 minutes of break, not really a break, a time for a Q&A. Let's make it a bit interactive. If you have any questions, please drop in, please speak up or write whichever way comfortable to you. And I would be happy to answer, and maybe and then we can move on to section two of it. Hi, is there any question from anyone so far?
Yes, sir. Tarun sir, you are not audible.
Oh, sorry, I think I was on mute, huh? Okay, let me. Okay, sorry, everyone. I think I was on a mute and I run through the entire slide while I was on mute. So let me let me repeat it. I guess before we start the journey to raise a venture capital fund from a venture capital investor, we need to ask some fundamental questions to ourselves. Should we approach a financial investor or should we approach a strategic investor? A VC investor is a financial investor who simply provides you the money with a clear cut objective of making a return and tons of money so that they can return capital back to their investor. On the other side, a strategic investors has a strategic view towards your business. Given a choice, I would always advise any and every businesses to actually hunt for a strategic investor rather than a financial investor, which can make a hell lot of value add to your business. Imagine you are a startup in the automobile industry, or you may be doing some innovation work into electric vehicle, right? And maybe a large company in a similar sector, it could be, let's say, a Hero Honda or maybe a TVS Capital, and there are many more. Makes an investment into your business. They understand your business better than any other financial investors. So it's always good to go for a strategic investment. Two, second fundamental question that we all need to ask: do you really need external fund, or is it the right time and stage to hunt for funding? Basically, both are interrelated questions. What I see in the market, there are thousands and thousands of startups who are in the race, and they are just hunting everywhere to get the contact details or to get connected with any VC fund and make a pitch. They're not asking these fundamental questions. Can I bootstrap more? Can I borrow some more money? Can I sustain for another 6 months? Is it the right time for me to actually hunt for a VC investor? Is it the right stage? And I guess it's too early investment into your business, or maybe too late investment into your business. Both are detrimental to your venture. You need to really find a fine balance between the need, the time, and the stage of your funding. An advisor definitely can help you here. $1 million questions: debt versus equity. I don't have to explain in detail what is debt and what is equity to my fellow colleague. But unfortunately, again, what is more expensive? Is debt more expensive or equity more expensive? Right? Everybody is heading for equity, because equity comes free, right? You don't have a repayment obligation. You don't have an interest obligation, while you don't have an obligation to repay equity. That's the simple way every founder, every business owner understand the difference between a debt and equity. Unfortunately, this is not the uh, uh, fair amount of financial wisdom, I would say. Given a choice, I would always look for a debt than an equity, because equity is very, very expensive. And sorry, I'm getting some noise, I guess, from the tech support team. Can you please put yourself on mute? Hi, my colleague from the Tech Support Team Institute, can you please put yourself on mute? Thank you. Let's take an example. you're running a nice business with a huge growth potential, right? And you strongly believe that in 1 year or 2 years down the line, you will be able to grow your business substantially, and the value of your business will also go up drastically, right? Given a choice today, I would not advise you to take equity, because if you take equity today and assume you sacrifice certain portion of your ownership to an external investor, it could be anything in the range of 10 to 20%, right? Let's say you give 20% to an external investor, right? And let's take an example that you are at 100 crores of sales, and 2 years down the line, or maybe a year down the line, your business goes up to 200 or maybe a 300 crores of business. Now the 20% stake that you have shared with an external investor, that is worth much more 1 year down the line what it is today. So if you would have taken a debt, you would have repaid that debt at an interest cost of 10, 11, 12, 13, whatever percentage it is, and you would have been holding the entire 100% equity, which is worth more than what you can imagine today. So if you're confident about your business, if you're confident about the growth of your business, and if there is a possibility of a debt is being available to you, take the debt, use that money, grow your business to the next level, and then go for equity. I'm not saying don't go for equity, but wait for it till you really, really need it. Well, are you ready? Yes, everybody will say, yes, we are ready. When it comes to receiving cash, everybody is always ready. But do you have a clear-cut business plan? Do you have a clear-cut business strategy which you wish to sell, which you plan to sell to prospective investors? If you don't have it, please go back to the drawing board, think about it, deliberate internally with your co-founding team, and decide what is it exactly that you wanted to do, how you wanted to do it, what's the strategy to grow your business from X to 5X. If you don't have clarity to these questions, it's a complete waste of time of reaching out to a prospective investors. Second, is your pitch deck ready? Do you have a presentation, which gives you an overall understanding about your business plan, about your business, which you can submit to the prospective investor? Is it ready? If not ready, please prepare that. Do you have the financial model, which is nothing? We call it as a financial projection, the 5-year projections of your business. Is it ready? If not, please go back to the drawing room and build your financial model on an Excel sheet and get it ready. How much funds you need and what's the utilization of the fund. You need to have a good clarity of how much money that you need. This is with my personal experience. I have seen that this is a common problem, or I call it as an issue with most of these startups. They ask for crazy amount of money from the investor. I've seen people they have just started business about 6 months back, or less than a year, or they have just clocked a revenue of 20 lakh, 30 lakh, 40 lakh, 50 lakh, or they have just launched a product. And when you look at their pitch deck, they're looking for $5 million, $3 million. They're fascinated. They're attracted by the ecosystem of the of the startup. It's like paisa to free mein bat raha hai, you just go and write, I'm looking for a $2 million check. It's not the case. You got to really look at your business. How much funding is ideal, and how much? Two questions: how much is ideal for you? That's number one. How much your VC investor would be willing to invest into your business? considering the scale of your business, right? That's also an important question to ask. You need to have a very, very clear plan of the utilization of the money. Where I'm going to spend this money? Is it more of marketing and advertisement? Are you going to buy some hard assets? Are you going to use the money to hire some talent and whatnot? So you need to have very good clarity as far as the utilization of the fund is concerned. And it is advisable to actually consult your colleagues from the industry and get a real insight that यार कितना पैसा रेज करना चाहिए. Is it $500,000? थोड़ा कम करो या 1 million करो. It's a subjective question. There is no formula, which I can share with you that this is an ideal ticket size that you should be looking to raise. Valuation expectation. Well, this is a very, very debatable and questionable subject. We can speak for hours and hours. So I guess in this particular session, I wouldn't spend too much of time onto this subject. But one thing that I would advise most of the startups, that when you approach a prospective VC investor, when you connect with them, right, don't think and don't talk too much about valuation, right? I've seen hundreds and hundreds of pitch decks wherein they shared their financial model with a DCF working, right? And they come out with a crazy amount of valuation. Trust me, guys, crazy. Huh? When you ask them, how did you get this number? The answer is simple. Sir, we have done a valuation done from an external valuer. Here is the working. And when you look at the working, it is what? This is the DCF. What is DCF? DCF is nothing but a present value of future cash flow into your business. The entire working of DCF have hundreds of variables. Everything is future. Your weighted average cost of capital is the cost of equity, your cost of debt, your cash flow for the next year, or sales number for the next year. You projected based on certain assumptions, some crazy number for the next 5 years. You run a maths. You arrive at a present value of a future cash flow, which comes to somewhere, let's say 300 crore. And you say this is the valuation of your company. I'm sorry, this is not the valuation of your company. So again, a lot of understanding and education required as far as the valuation expectations are concerned. My advice to you, I guess it's important to secure an interest from a prospective VC investors. And once you have a serious interest on the table, you should definitely consult with your colleagues from the industry, with your advisors and many other people, and get an insight onto the business, that what should be the right valuation for my company, how much equity I'm willing to sacrifice, what should be the right equity that I should ideally sacrifice, what is the offer on the table, rather than holding on to that crazy number onto your head on the valuations is concerned. Oh, this is, I guess, the one of the most important slide for the day. Everybody is curious to know, how do we approach to an investor? I have a fantastic business idea. I've launched my product. I'm looking to raise $1 million. What do I do? How do I reach out? The first and foremost step in this process is qualify your investor. Like now, we have a database of, let's say, at least 1,000+ investors, right? I've read every single investors who are currently investing into the Indian market. When I see qualify your investor, it's not that you can submit your pitch deck or your proposition to just anybody and everybody. Please make sure it qualifies. You got to read about that investor, right? What is their investment thesis, right? What kind of investments that they have made in the past? What is a typical average size of investment that they usually make, right? So read about them, go to their website, go to their LinkedIn page, understand their their philosophy, understand their investment thesis, and then decide, is my business connect well with their investment thesis or not? Is it the right investor I can approach? If the answer is yes, then only your step to start. If not, there is just no point in talking, communicating, or reaching out to that particular investor. Step two, so once you qualify, okay, this guy seems to be perfect. I belongs to an education industry. This guy makes an investment to education. I'm looking for $1 million. This guy makes an investment in the range of $1 to $3 million. The ticket size भी match हो गया, sector भी match हो गया, business भी match हो गया, and so on and so forth. The next is connect with your investors. How do you connect? Now, this is again a lot of experience and learning is required. Everybody is on social media today, and you see founders, business owners making cold calls or cold connects, trying to reach out to a prospective investors. The investors may not respond to your message, even if they have seen it. I've seen businesses making and writing messages which they ideally should not. They write the entire pitch in a LinkedIn message or maybe some other social media platforms. That's not the right approach, frankly speaking. And you really need to work hard. It's a very, very time-consuming task to connect and securing their contact details. That's where the role of an advisor comes into the picture. Next is send your pitch deck. Again, how do we prepare a pitch deck? We need to have another session. I've seen in my laptop, I would have at least 1,000+ investment decks saved. I've seen all kinds of investment decks, and trust me, half of them is not up to expectations. So what can be captured, what should not be captured, how we prepare it, it's again a big question. And I guess we can't talk too much in this particular session, but it's important that you prepare the right pitch deck, capture the content which is reasonable, not too less, not too much, plus capture the relevant content. Don't try to give gyan to a prospective investor. I see a lot of gyan built into the slides, a lot of data on market, industry, talking about India, talking about problems, this, that. Arey baba, koi nahi pad raha pe. You've got to talk simple, basic things. Kitna dhanda kar liya hai, shareholding kya hai, what is your problem statement, what is the solution? The meaningful detail is not being shared, but the gyan is being incorporated and running through and overloaded in your presentations. Be straight to the point, keep it simple and straight, share numbers, share meaningful and relevant information which help a prospective investor to take a decision. If you overload him with too much of unnecessary information, he's not going to show interest for sure about it. So again, it's a journey in terms of what you should ideally cover and what you should not be covering. Well, be ready for a no or a no response. I can tell you and share you with a lot of experience here that you may not get a response from the investors. Every single investor is bombarded with tons and tons of email and communication and pitch decks from all over the country, right? And they do not take too much of time in thinking in their head whether it's yes or not. If it is not, they will just move on to the next. 30 seconds, 1 minute they will spend and done. Yaar, ye nahi hai, वो first level पे ही filter हो जाता है. What is the first level of filtration? The first level filtration is the investment thesis. Even if you have read about the fund investment thesis, even if you have understood the kind of investments that they have made, even then when you reached out to them, you will be out in the first level of filtration. So don't get disappointed with the number of no or no response that you keep accumulating in your kitty. How it works. So sorry, I'm just having my this headphone is pressing my ear too much. How it really works. What is step one? The step one, you submit your pitch deck to a particular fund. So somebody is representing a fund, some member of the investment team to whom you have shared your pitch deck, or you shared your teaser or financial model, whatever you call it. What happened? Let's say the gentleman, he started showing interest. Yeah, this looks, the first level clearance is done, and it's fine. So they typically, wanted to have a first level of deal introduction call, a business introductory call, where an investor would like to get into a detailed discussion with the founder, trying to understand the business model more in detail, trying to secure those details which is missing in the pitch deck. And at times I have seen, not at times, but most of the time I've seen, and be ready for it, that a VC investor would not have spent too much of time onto your pitch deck. He just spent, let's say, maybe a minute, and he said, okay, this is fine, let's have a call. Okay. Now, when you got into a call, you're expecting the investor has showed an interest, and he has read your entire pitch deck in detail. Unfortunately, the answer is no. He may not have gone deep dive into your pitch deck. You will have to run it through step by step, slide by slide, and make him understand about your business model. So very, very recently, as late as 2 weeks back, I happened to interact with one of the investors. I sent him the pitch deck, and he next day he called me. Wow, this looks interesting. Let's talk. Next day we had a call, and he said, "Oh, Tarun, this looks interesting. Can you share me the this model, that financial projection, etc., etc." And then he said, "Have you raised $5 million?" I said, no, I haven't raised. I am looking for $5 million. He said, no, I have looked at your slide that you're looking to raise $3 to $5 million. I said, no, I'm looking to raise $3 to $5 million. I haven't raised this kind of money so far. That slide that you're talking about, I have given a reference to another transaction which has been funded by another investor to an extent of $3 to $5 million as a reference point for you. Oh, I got it. Sorry, let me just go back and check. So at times they are so quick, they're so fast, they may not read your pitch deck, thoroughly, and they expect you to run them to the entire business and the details about it, right? So be ready for it while they understand the business, but you will have to take them through the entire business. And then you keep exchanging further information, documents, you have valuation discussions, and then in the fund, you have internal discussion. The deal team, as I mentioned earlier, consists of two sets of people. One is the fund manager, and second is the analyst. So a particular deal, a particular company is being assigned to a deal team who's supposed to work on that deal, make a proposal, and submit it to the investment committee. Deal pipeline meeting typically, every week or every 10 days or every fortnight. The tons and tons of proposals that they receive from different parts of the world, they accumulate it. The entire investment committee comes together, and they quickly, run through each and every proposal. So we call it a deal pipeline meeting, where they filter the deal. Acha, rejected. Okay, in progress. Fine. Okay, go ahead. Let's reject it. Okay, yes, no, this, that, and then just go on like this. Okay, we have got 6:22. So very quickly, I'll move so that we have time for questions. Term sheet is a non-binding agreement that shows the basic terms and conditions of an investment. The term sheet serves as a template and a basis for more detailed, legally binding documents. Term sheet is basically a smaller version of the shareholders agreement. It's basically 2, 3, 4, 5 pages of document which summarize the understanding, the basic terms and conditions which is agreed between an investor and the founder. It is signed by both the parties, and this is the first level of written commitment on the part of the investors. And basis this term sheet, we move to the next level. Next level is due diligence. After the term sheet is signed, the investors, either they will do due diligence of your business at their own, or they may appoint a third-party vendor to do the diligence and submit the report back to the investor. So you could possibly have a due diligence in the finance and accounting. You could have a diligence, tax diligence. You will have a business diligence, ESG, forensic and market survey, and technology related diligence. Basically, the objective of this due diligence onto your business is the investor is verifying that whatever representations that you have made so far in your pitch deck, in your calls, in your financial model projections, they are cross-verifying every single number, every single information, every single representations, right? So make sure that whatever you submit to a prospective investor, it should not be exaggerated, it should not be wrong, right? And be ready. This will all be verified and checked by the investor himself or by their appointed third-party vendors. Well, the D-Day has come. After the due diligence is done, assuming that there are no material deviations from the representation that you have made, the investors would be willing to execute the shareholder agreement. It's basically a legal agreement between the investor and the business owners, where the investor commit to make the funds available, and basis the execution of the shareholders agreement, the GP, the investor, the investment manager, they will draw a capital call notice, send out to their limited partners or LPs, draw the funds, and ultimately make the funds available to you. And that's how the funding will be done. Last step, once the funding is done, you will be holding the first board meeting on the day when you receive the funds into your bank account. You allot the equity shares, you appoint their representative as the board members, and that's how you have a new external institutions entering into your world, and you have a journey started here. So good that we finish it on time. It's 6:26, and it will be good that we spent more time on questions and answers so that it's interactive. I would be happy to take up questions from all of you. Feel free to ask as many questions as you can, and I will try to answer those. My colleague from the tech support team, can you hear me? My colleague from the tech team from ICI, are you hearing me? Can we open up for the question and answers? Okay, all right. I have the question. I will read the question one by one and try and answer it. So I've got this question: if the business invested in is not scaling as envisaged, what is the exit strategy of the fund? Does it arrange for alternate debt arrangement for the startup or venture it has invested? Okay, very interesting question. Well, if your business unable to meet the expectation of the investors as far as your business growth and projections are concerned, and again, whether they will obviously try every bit to protect their investments. Generally, in funds, they always keep a reserve, which we call it as a follow-on capital, right? This is basically to meet the contingent situations in their portfolio companies. So at times what happened, and I have practically dealt with one such case wherein we had invested in one of the portfolio company about $10 million many years back. The company did not do well, and they were looking for more cash and resources, and no outsider were looking to further invest into their business. So we use our cash reserve out of the pool that we have in the fund. We invested a bit more money so that we can save the big check which we have already invested, so that we can fuel the business, right? We tried everything, every bit of effort to ensure that the business survive, the business is up and running, so that we can recoup our investment. So as far as investor is concerned, this is given. They will do everything, right? They might go for a follow-on funding from their own pool. They might try to arrange an external debt funding or an external equity capital. The question is your business ready, capable to attract more funding or not? Right. So it is like you are again going to the market trying to make a pitch that I'm looking for another $1 million or $2 million, and this is my proposal, this is my pitch deck. So it's very, very professional and independent way of securing another round of funding, but there is no obligation that your existing investor has taken that they will make another round of funding. Yes, if they think that with another $1 million check or another round of funding, they would be able to stabilize the company, they will be able to bring the company back onto the track, they will definitely bring some money from their own pool. We call it follow-on capital, so that the business can be revived and they can recoup their entire investments, right? So that's how typically the investors would do. I'll move on to the next question. I'm a CA intern student. I have completed articleship. I have a query. What is the impact of emerging technologies on job of venture capitalist? Well, I guess the impact of technologies on the venture capital industry is that you have majority of the funds looking to invest in businesses which is technology oriented or tech-enabled services. And I consciously use this word, majority of the businesses. Everybody wanted to invest in technology-driven businesses, innovative businesses, and so on and so forth. As far as the job is concerned, it becomes very, very critical that every investment team member of a venture capital fund should be well aware, should be technologically sound, so that when you evaluate a prospective investment opportunity, you're able to connect with the business, with the investment, and you're in a position to take that decision. You should understand if you may not have the expertise, but you should understand the technology. You should have the basic understanding of artificial intelligence, machine learning, Web3, crypto, and some of these things which is currently prevalent in the market. So yes, those who do not have a fair understanding of the technology and related vertical, it would be difficult for you to actually secure a job in any venture capital fund. So yes, that is how it's going to impact the job of a venture capitalist. I'll move on to the next. Okay, this question continue. As most of the startups don't fly and end up as dead investment, even few post-IPOs are dumped due to unwanted and exorbitant valuations. Don't you feel this all fuels to an unforeseeable crisis in future? Innovation is the main feature of new age companies or startup companies. Sir, excellent presentation. Can you please explain carried interest concept once again? Carried interest is nothing, as I mentioned earlier, it's some kind of a bonus or incentive which is being paid to the general partner, GP. And then ultimately it is shared between the investment team members. So let's take an example. You set up a $100 million fund and you end up making 30% IRR. I'm just giving a example, 30% IRR in the fund. So within the charter document, it's been clarified that if you cross the hurdle rate, generally the hurdle rate is in the range of 8 to 10%. So if you cross the hurdle rate, which is 8 to 10%, and whatever excess that you have made, a certain portion of that return, the capital gain, will be paid to a general partner, which is meant to be shared with the investment team of the GP. So that's like an incentive. If you do well, you are being paid. If you don't do well, sorry, you won't be paid. What professional opportunities are available for practicing chartered accountants in the VC funding ecosystem? I guess most of these startups and most of the companies are not ready in terms of their journey to secure funding. It could be preparation of a pitch deck. It could be working on the financial model. It could be advising them in qualifying an investors and reaching out to an investor. There is a lot to be done actually, because these business owners do not understand too much the financial and investment world, and there is a need for all my colleagues and practicing chartered accountants to pitch in and do a relevant advisory work in this particular area. Any other questions from anybody? I mean, I can keep talking more and more. I can revisit some of the slides or any other question that you might be having. I'm happy to answer it, or maybe revisit some of the concepts that might not be clear to you.
I don't think any questions are there. You just summarize, sir. Summarize for that one is particularly whatsoever you have right now taken off. That one is up to 7 minutes or 8 minutes by the whatsoever there. Please summarize the total session.
All right. I'll quickly, I'll spend few seconds, what we have learned so far. So we talked about a vibrant ecosystem of venture capital and private equity investments. An amazing number that we have seen, $38.5 billion of investment in 2021. We deep dive into how funds typically operates, two sets of people, GPs and LPs, two sets of institutions who comes together and make a pool of money. It's the GP who is also acting as the investment manager, who's running the fund, managing the fund, and administrating and doing every damn thing which ideally an investment manager should do. And in return, they get management fee and carried interest. What kind of investment that we have? We've got family offices, insurance companies, mutual funds, sovereign wealth fund, development financial institutions. All of these, could be your prospective limited partners. We talked about the first close and the final close of the fund, which is basically refer to a two different milestones as far as the fundraise is concerned. We talked about investment thesis. As I mentioned earlier, this is the most common problem, challenges faced by almost everybody in the entire ecosystem, all stakeholders, whether advisors or the business owner. It's very, very important that you understand the investment thesis of a venture capital fund and make an informed call before you make a pitch to a prospective investor. We talked about the investment period, which is generally 4 to 5 years, within which the fund is supposed to use the money that they've got commitment and make an investment into number of portfolio companies. We talked about venture capital and private equity, which is nothing referring to different stages of the business. If it's an early stage of the business, we call it venture capital, and if it is a late stage, we call it private equity. We talked about different rounds of funding. Once again, it refers to different stages of the business, starting from a pre-seed round to a seed round to a bridge funding to pre-series A to series A, B, C, D, and so on and so forth. So all of these rounds of funding refer to different stages of the funding. We talked about the difference between committed capital and capital call. Committed capital is the capital which is committed by the limited partners or LPs of the fund into the fund. This capital is not actually disbursed. It's only committed on a piece of paper. We talked about that venture capital co-investing is on the right. Most of the deal that gets funded in the market, over 95% of them are contributed by more than one investor. We have seen majority of the deals being funded by sometimes 3 investors, 4 investors. This is also a risk mitigating strategy as far as the fund is concerned. Various category of investors that we have seen in the market: incubators or accelerators, angel networks, private equity and venture capital, family offices, and strategic investors. You need to really make a good assessment that who should be your target category of investor. Should I approach an incubator or accelerator, or should I approach an angel network? It all depends on the timing in the stage of your business. If you approach a wrong category of investors, it's going to be a waste of time and you might fall into disappointment. These are some of the names that you get to hear from the incubator and accelerator industries. These are some of the angel networks. Some of the famous one are Mumbai Angel Network and Indian Angel Network, which is quite active in the market, making number of investments every single year. These are some of the names of the family offices, which basically represent a large industrial business houses. They have been also very, very active as far as the investment space is concerned. Again, various category of investors, this is their investment thesis. We talked about venture capital funds. We talked about private equity funds. We talk about buyout funds, whose investment thesis is actually to buy businesses or to acquire a controlling stake. There are special category of funds, which is distressed and a special situation fund. And then you have venture debt fund, who makes a debt investment and operate in a completely different manner, unlike a typical bank or an NBFC. Section 2 of the presentation, we talked about in a step-by-step guide, how to secure a venture capital fund. We talked about two categories of investor, the financial investor and a strategic investor. And it's important that we get a fair understanding that which investor ideally I should be looking at, and what is the benefit of having a strategic investor on board versus a financial investor. Big question, is it the right time? Can I wait for another 6 months? Should I raise $500,000, or should I raise 1 million, or should I raise maybe $100,000? Do I really need funds at this stage? All of these questions needs to be deep dive, discussed internally with your co-founding team, with your advisors, and reach to a decision. Big fundamental questions: debt versus equity. We all understand the difference between a debt instrument and an equity instrument, but it's not common that we are all looking for equity investment. Everybody think and feel that equity is free, but let me tell you, equity is very, very expensive. Given a choice, I would always advise every and other businesses to actually go for a debt rather than an equity. Are you ready? Do you have a clear business plan, business strategy? Have you prepared your presentation? Do you have a financial model, which is nothing but a financial projections prepared on an Excel sheet, which represent your vision, which represent and a replication of your business plan and business strategy? How much fund that you really needed? It's a very, very important question. Most of the startup companies and founders, they come out with a crazy ticket size in terms of the funds that they are looking at. So you also need to see that how much market is willing to give it to you, right? You may be looking for a moon, but not necessarily you get that. So please consult with your advisors and reassess your requirement. Valuation expectation. This is again big questions. It's everybody's startup founders is always looking to dilute less, while a venture capital investor is always looking for more. It's a tussle between the two sets of people. It definitely needs a lot of education and understanding. How do you really manage your valuation expectations? How to reach out to the investors? You need to qualify your investor. Are you reaching out to the right set of people or not? Connect with them, secure their contact details, send you a pitch deck, and be ready either for a no or a no response. How it really works: once the investors start, once the investors showed interest to your business, they start discussing the business more in detail with your founder. They will exchange further information, documentation. They will discuss and understand your valuation expectation, and so on and so forth. So that deal team will internally discuss. They will hold a deal pipeline meeting where they will, all the members of the investment team sit together and they filter the deals. Is it a good deal or not a good deal? Is it a bad deal? Can we pursue it, not pursue it? All these decisions are generally made in a deal pipeline meeting before a detailed evaluation process starts. Big day, term sheet is, as I mentioned earlier, it's a summary document. It summarizes the understanding between two sets of people in terms of how much you're ready to commit, what is the valuation, how much you're ready to dilute, what are the other terms and conditions and rights that investors are going to take. All of this will be captured in a term sheet, which is typically in the range of 3 to 4 pages. It is signed by both the parties, and this is the first written document that comes into the existence, and that becomes your basis for executing the shareholder agreement. Next step is due diligence. After the term sheet is being signed, the investor will do the due diligence across function, whether it's finance, accounting, taxation, business, forensic, ESG, technology related, basically to check and cross verify all the representations that you have made so far in various documents that you have submitted, including your pitch deck, including your financial model. And finally, the D-Day has come, time for the legal department, the lawyers of the investors, the lawyers of the company, the business owners to come together, negotiate, or draft a shareholder agreement, discuss, agree, understand, and finally sign it. Once you sign it, the investment manager or the general partner, they will send out the capital call notice to their investors who will disburse the fund to the fund first, and the fund will make a further investment into your company. That's how you receive the fund. And on the day when you receive the funding from the fund, you will be allotting the share in the very first board meeting that you held. And that's how you complete your journey in this fashion. Generally, I have seen the question comes up: how much time is generally take to secure a fund? Again, it depends on the stage of your business, how much money that you need. If it is a startup, if it is an early stage business, it could be anything between 2 to 3 months, a minimum 2 months, an average of 3 months. If it is more mature and established business, typically looking for a bigger ticket size, it could be anything in between 4 to 6 months. So that's the average time frame which most of these investors take for early stage business, anything between 2 to 3 months. And sorry, I have my battery fade out. Let me just, okay, great. So that's the usual time frame for these VC investors to complete their investment. I must say that raising funds is a very, very time consuming and a complicated process. It's not easy. There are thousands and thousands of startups currently in the market trying to raise capital. We are all currently living in an ecosystem where every single startup is dreaming and thinking that some angel investor would come and save them. Guys, let me tell you, not everybody gets funded. For all of us, the focus should be on business or building an excellent business model. If you run a good business model, if you are able to reach to any scale, trust me, funding is an automatic process. You will attract funding once you have developed a nice and a stable business model. Don't be in a hurry, build your business, and then focus on funding. That's all from my end, Dr. Sambit, until you have anything to say. And I'm happy to take more questions if there be any.
Is there any question, sir? I think no questions are there. Okay. We are thankful to CA Tarun Chaurasia on highlighting open the various issues on that one as venture capital funding. And we once again thankful to you for that one is deliberating upon various aspects of that one is how the roadmap can be built on, particularly in that one is venture capital funding. We are also thankful to all the participants who have joined this live webcast. We once again thankful to all of you, and with this we conclude this live webcast.
Thank you, Dr. Sambit. It's been a pleasure spending time here and sharing a bit of insight onto what I've learned so far. And thank you very much, everybody, once again.